The US presidential election is just a few days away, and with it being one of the most impactful events for global markets and economies this year, many of us will certainly be closely watching it. That's why in this video, I'll be sharing what the election means for the US stock market, what the historical data says, and of course, who might be the winner. Is it Donald Trump or Kamala Harris? But before I start, do join my 10,000 members Telegram chat group to discuss stocks and personal finance. So if you look at the national polls, you will see that both candidates are pretty much going neck to neck with one another, with Harris leading slightly ahead. And according to the S&P 500, which since 1928 has an 83% accuracy of predicting the winner, predicts that Harris will win this round. So what it says is that if the S&P 500 is positive in the 3 months leading up to the election, the incumbent party will win. And since the S&P 500 was up by 10% over the past 3 months, this means Kamala Harris will win, right? Well, not quite. Because while the S&P 500 was quite accurate in its predictions, there were also times when it was wrong, due to anomalies in the economic and political circumstances. For example, in 1956, even though the S&P 500 fell, the incumbent president still won, as he had a higher approval rating thanks to record employment, high wages, and stable prices. Then, in 1968, even though the S&P 500 gained 6%, the other party won, because the incumbent president nominee, Robert F. Kennedy, was assassinated. Likewise, in 1980, there was an oil crisis going on, and in 2020, the pandemic happened. So, this means that just because the S&P 500 did well recently, it doesn't automatically mean that Harris will win. It's like saying the stock market does well whenever there's a full moon, and does badly when there's no moon. Like, not related leh. But this time, what could the anomaly be? According to Morgan Stanley, the Michigan Sentiment Index hasn't been this low in the October of an election since 1987. This could signal that the election is in the challenger's favor. And indeed, the markets are now pricing in a Trump win. For example, on the betting market, Trump now has over 61% chance of winning, while a basket of stocks tracked by Morgan Stanley showed that Republican-related stocks are significantly outperforming Democrat-related stocks. Not just that, the crypto market has also been going up recently. This is because while Trump was anti-crypto previously, he suddenly turned pro-crypto, which means his win would be favorable for the crypto market. At the same time, the long-term treasury yields have also gone up. This is because if Trump wins, he would impose tariffs on imports, which can cause inflation to go up, which pushes bond prices to go down, and in turn causes bond yields to go up. So investors are now trying to front-run this. Now, of course, all these are just predictions, and realistically, no one knows who will win this election, unless you are Fatko. But let's take a step back and understand what each party stands for and what their wins could mean for the economy and the stock market. Quick pause. With markets giving high returns over these past few years, and with more interest rate cuts around the corner, there's no better time to start investing than right now. But if you're afraid of starting now, especially at all-time highs, no worries. That's because Mumu has a strategic partnership with Nasdaq to host the global US stock simulation paper trading competition, which offers you a fun and risk-free way to learn how to trade US stocks. You will start with $1 million in virtual funds, and as long as you have a positive returns every week over 5 weeks, you will win a share of 100,000 US dollars rewards with other winners. Top 3 winners in your local region will win up to 1,000 US dollars in stock cash coupons, while the top 3 global winners will win up to 10,000 US dollars while getting featured at the Nasdaq screen in New York Times Square. And the best part, participation is completely free. All you need to do is use my link to register for the competition, and you'll get a 1-month additional access to Nasdaq Total View market data that's worth $25.99, valid for 62 days. New users will get to earn up to $1,034 worth of welcome rewards. Plus, both new and existing users will get to enjoy zero commission for Hong Kong stock trading for 30 days. Zero commissions on US stocks, as well as zero commission trades on US options every month. For more details of the promotions, do refer to the link promotion page in the description below. On one hand, Trump and the Republican Party focus more on growth and protectionism, while on the other hand, Harris and the Democrats focus more on social insurance. For example, If Trump is elected, he plans to introduce 10 to 20% tariffs on all imports coming into the US, while giving China imports a 60% tariff. This is because he's trying to protect domestic companies from foreign competition. However, the downside of this is that this will make imports more expensive for US companies, which could lead to a rise in inflation. At the same time, this could cause China to retaliate by raising their own tariffs, and there will be a trade war all over again. However, the good news is that Trump plans to lower the corporate tax rate from 21% down to 15%, which can help companies save quite a bit of money, like what happened back in 2016. Not just that, Trump's win will be beneficial for the oil and gas sector, defense sector, and Wall Street. Basically, things that can boost the economy while protecting the country. Meanwhile, Harris plans to focus more on the renewable energy sector, semiconductors, as well as the healthcare sector. However, her winning isn't exactly good news for US companies, as she plans to raise the corporate tax rate to 28% and raise the minimum wage to $15 an hour, which means company expenses will increase. So, where will the stock market go in the short term? In weeks leading up to the election, the stock market has on average performed poorly. But once the election is over, the stock market tends to rally all the way to December. So, what are? Again, not so fast. Because if the election result turns out to be very close, it would take a while to recount the ballots, which means uncertainty, something which the market hates. For example, in 2000, Bush won the election in Florida by 537 votes, or by a margin of 0.009%. And for over a month when the recounting took place, the S&P 500 fell by more than 8%. As for the coming years, it mostly depends on who is in power. If both the White House and the Congress are from the same party, the market tends to give a lower return. Whereas if you get a divided Congress, the market tends to give a higher return. This is because when the Congress is divided, it's harder to get things done. As a result, you get more stability and more assurances that the government isn't going to go in any extreme way. But if you break it down, the first year of the presidential term tends to give a slightly lower return as compared to election years. And in the second year, the return goes even lower before going back up in the third year. Some say that this could be due to higher federal spending in the third year, while others point to Fed policy patterns in the various years. Though, there have yet to be any reliable, concrete explanations as to why this might happen. But here's a question. Which president is better for the stock market? If you look at historical data, it will show you that the S&P 500 did better when a Democrat was in power. So, does this mean that Democrats are better for the stock market? Not quite. That's because you need to remember what each party stands for. Democrats focus more on social insurance, while Republicans focus more on growth. And because of that, they tend to get elected based on which economic cycles the country is currently in. For example, when the economy is weak and unemployment rate is high, the US people are feeling a bit more risk-averse, and because of that, Democrats are more likely to be elected. While on the other hand, while the economy is going strong, people tend to feel less risk-averse and would want to elect Republicans for their growth policy. Because of that, Democrats get the benefit by starting from a low base, while Republicans will fare a bit worse because they started off from a higher base, which explains why the markets did better when the Democrats were in power. So, who will win this election? Market odds aside, it's definitely hard to tell. For example, a September poll from Ipsos finds that Trump has an advantage over Harris in this election. That's because even though there are more Americans saying that they support Harris, and even though more people feel that Harris is handling her campaign well, more Americans trust Trump over Harris when it comes to key issues, such as the economy, immigration at the US-Mexico border, and inflation. On the other hand, a historian who correctly predicted almost every recent election since 1984 says that Harris will win, as she holds the most keys to the White House. But if you ask for my fun, non-political, possibly wrong prediction, I would say that Trump has a higher chance due to the economic climate that we are in. But whatever the case, the biggest lesson that I've learned is that nobody knows what is going to happen next, not even the market. So the best strategy is to practice some humility and continue to dollar cost average no matter what. Market up, you buy. Market down, you cry a bit, then you buy some more. Because the market doesn't care which president is in power, and will just stonks either way. barring any unforeseen events of course. Anyway, that's all for this video. Hopefully you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.